The global liquefied natural gas market, LNG market, has taken a few market shocks recently. On January 26th, the White House announced a temporary pause on permitting for the sale of LNG to countries with whom the U.S. does not have a free trade agreement. At the same time, the war in Ukraine continues, and as that war rages on, how are LNG markets in Europe affected? And finally, LNG supply has increased from both the United States and Qatar. How will the growth in LNG affect the overall market? I'm Emmett, a fellow at Rice University's Baker Institute for Public Policy in Houston, Texas, and this is Baker Briefing. Here with me today are Gabe Collins, fellow at the Baker Institute. Technically, his title is Baker Botts Fellow in Energy and Environmental Regulatory Affairs, and also Stephen Miles, another fellow here at the Baker Institute Center for Energy Studies and senior counsel at Baker Botts. Thank you both for being here. I've outlined three shocks that have hit the LNG market recently. So let's start with the first one, the LNG permitting pause. China is now the largest designated destination by volume under all long-term U.S. LNG contracts. How will this restriction, even if it's not an outright ban, affect the U.S. LNG market?
Thank you, Ed. It's a pleasure to be here. Well, on the one hand, you could say, gosh, China only accounts for a total of 4% of all of U.S. LNG exports through 2023, but it's now the largest designated destination by volume under all long-term U.S. LNG contracts. And even more importantly, it accounts for 25% of the volume of all long-term contracts entered into by LNG export facilities affected by the DOE's LNG export pause. And so even though LNG traders or portfolio buyers are becoming the dominant purchasers from LNG export projects in the U.S., these LNG buyers from China are the largest single destination buyers. And as such, they're underwriting a large amount of the U.S. LNG export projects, both existing and potentially in the future. So restricting one way or another exports to the China market could have an impact, though it depends upon exactly what such a restriction would look like. And we outline in the paper several types of restrictions and decisions that DOE could take. And Gabe, I don't know if you want to address some of those.
Absolutely. So there's a few degrees of gradation here. If we think about kind of a light pause on LNG shipments to China, perhaps from projects going forward, it introduces a higher degree of risk into the market. And it's something that, as Stephen alluded to, many of these Chinese customers have been anchor buyers who have helped solidify the ability to finance the liquefaction facilities, particularly the ones that reached final investment decision over the last 4 to 5 years and are starting to come online now. And so it would raise questions about potentially the viability of some projects moving forward that might have otherwise gotten a green light to proceed. If we imagine a scenario that is sort of the ban heavy, where you not only have a restriction on future sales, but potentially even have provisions kind of like what we've seen in a Senate bill introduced by a handful of senators just within a few days of the potential restriction on sales to China announcements from DOE, that would be a very different situation, because at least as some of that legislative language is drafted now, it could potentially be read to even affect existing agreements. And so that's something that we think is obviously far less likely. But that's one where there would be tremendous market impacts, not just in terms of wondering where these volumes can go, but also insofar as, again, this is draft legislation, but some of the language in it would suggest that you might be effectively eliminating the free on-board status of U.S. LNG. It's free tradability, where one party can lift a cargo and then sell it, depending on market conditions, to somebody anywhere else in the world that's willing to pay for it. That could really be called into question under some of the more extreme heavy ban scenarios.
That would be an absolute ban, such as the DOE currently has, right, Gabe, for North Korea, for Cuba, and for Iran. So if it were an absolute ban on the sale, even in the secondary market, an obligation that every off-taker include that ban in their downstream sales. That's really sort of the nuclear option, right? That would have a dramatic impact and would be the most far-reaching.
That's correct, Stephen. It would be profoundly market destructive. One thing to think about for listeners here, I know we've been very technical for some of the first part of our discussion here. Historical perspective is important as we look at these questions. And one of the things there's a couple of examples to look at when you think about how does supply of basic materials and energy commodities ultimately factor into U.S. state-level theory of victory in a competition with China, with Russia, with Iran, with North Korea, with this group of aligned states who do seek in many ways to oppose the rules-based order that the U.S. and its allies have built over the last,
the axis of resistance.
Years. Well, that's maybe a nice way to put it. But one of the things to think of here is, first of all, even during the deepest, darkest parts of the Cold War, the United States still supplied grain to the Soviet Union. There was a trading opportunity there. We had a surplus, they had a deficit. And in making those trades, we in no way prejudiced our strategic position, and we won that competition. And so there's really some key points to think about here is, do we want to be just restrictive across the board when it comes to trade with China, or do we want to be more selectively restrictive and say, okay, for instance, apex technologies like semiconductors, those do deserve to be restricted because they deliver such a competitive edge that you don't want your adversary having them. But when it comes to basic materials, I think we have to maybe take a different view of this. And then I think if you want to draw on another historical example is when you have a great power competitor who has a deficit in a certain resource, whether it's food, whether it's energy, any of the above, and you actually move, even though there's not an actual hot conflict going on, to exploit that deficit through embargoes or restrictions, does it actually exacerbate the conflict to potentially even accelerate the slide toward war? And if we look at the U.S. oil embargo on Japan in the summer of 1941, that was exactly the outcome that resulted from that. And so there's really some big strategic questions here. And I think we have an intersection where there's domestic concerns from certain constituencies about energy development. There's some constituencies that are very philosophically opposed to natural gas for a number of reasons. But there's also these high-level nation-state concerns that I think we need to be more cognizant of.
Great points. And I think that brings us back to the Natural Gas Act, right? And I think we need to talk about the Natural Gas Act for a minute too, because the Natural Gas Act talks about specifically this global commodity that's traded publicly, natural gas, and it says that exports shall be approved unless the Department of Energy concludes that it would be in the public interest not to do so. And so there's almost a presumption that they should be approved. And so that sort of leads us into the question, and Ed, this might have been where you were going to take us, and I'll defer to you, as to whether there are lighter courses of action that DOE could take as opposed to an absolute ban.
Well, I think I would point out at this time, the two of you recently published an article in Foreign Policy that lays out these scenarios. And while we can't cover all of those in a 25-minute Baker briefing, people can go read your thoughts on those scenarios. I would only add, as somebody involved in logistics and supply chain, we get so many products from China and so many basic materials that are used to make products here that this all ties together. It's not just about LNG. But let's move on.
May I add just one sentence about the paper? We outlined 3 lesser actions that the DOE could take that would look, let's call them ban light. And one of them is no action at all, but 2 of them are ban light, a reprioritization based upon whether or not somebody specifies China or not. These lesser actions would ultimately not really have much of an impact. They would be more visual than anything else. Traders would be allowed to work around them. It would ultimately just move China from being an initial FOB buyer to a secondary buyer. Existing China contracts from existing LNG, US LNG exporters wouldn't be affected. So there may be things that look like the administration is doing something that, in fact, don't have a lot of impact at all. And we outline those in the paper.
Good, good. So when Russia invaded Ukraine, one of the first things people mentioned was how much natural gas Russia was supplying to Europe, and that natural gas supply was virtually cut off. So as the war rages on in Ukraine, how has the LNG market been affected overall?
We've seen a tremendous reallocation over the last 2 years, particularly of volumes flowing out of the United States going to Europe. But previously, you had seen much more balance between U.S. shipments to customers in Asia and customers in Europe. This is prior to Russia's reinvasion of Ukraine. There's a few reasons for that. One is a lot of the anchor customers, including for the earliest U.S. LNG export projects, tended to be located in Asia. That's a part of the world where across a number of countries, energy demand is still growing robustly, which generally isn't the case in Europe. And also because Europe had access to this low-cost Russian pipeline gas that, as you correctly mentioned, was largely cut off both by Russian action leading up to the invasion, a purposeful restriction of supply, and then once the invasion had happened, a combination of European buyers affirmatively moving away, plus the explosions on the Nord Stream pipelines dramatically reduced those volumes. And US LNG stepped into that gap and helped fill it. Because if you think about the biggest LNG suppliers in the world, you think about the US, you think about Qatar, you think about Australia. Projects in Qatar and Australia were generally fully subscribed on long-term bilateral contracts. And so there wasn't much tradable LNG that was left that could be redirected to other parts of the world in response to shocks. The U.S. is a huge exception to that because the way contracts are structured here, and Stephen may elaborate a little bit more on this in a moment, gas is generally very freely tradable. And it's one of actually the unique contributions that the U.S. LNG sector makes is if there's a large market disrupting event, the flexibility is built into the contracts where gas supplies can be shuttled to different parts of the world to respond to those types of situations.
Okay. Stephen, you want to add anything to that?
Well, indeed, it's one of the primary advantages of U.S. contracts is that they are so destination flexible, but events may be overtaking us. And I think this leads to another series of questions you're about to ask, Ed. So if I'm jumping ahead, feel free to let me know. But the U.S. has been able to flex contracts from Asia to Europe and back again as situations require. Certainly following the Russia invasion of Ukraine in early 2022, 74% of all U.S. LNG flexed to Europe for the first few months, really filling an important void that was left there from the cutoff disruption of Russian natural gas. At other points in time, we see not just shortfalls from force majeure events, whether they're labor disruptions in Australian plants, whether they are fires or explosions or undersea pipeline disruptions, and cargoes can easily divert. That's a great safety mechanism that these contracts allow, but also the ability to take advantage of arbitrage between JKM prices and other Asian prices, Japan markers, and then, of course, getting into NBP and ICE and TTF and Henry Hub in the Atlantic Basin and back and forth, take advantage of those to keep prices more or less stable and to eliminate peaks, or at least to mitigate them. But we have a situation where that is becoming stressed. And we're leading to a re-Balkanization, I fear, of the LNG industry. And that's partially because of threats from nationalization, such as possibly this China ban, but other countries as well wanting to keep their gas close to home, but also the choke points. The Panama Canal, with the hydrological challenges it has from lack of rain, that has reduced passages through there. And of course, the Red Sea choke points. We have had not a single LNG tanker transit the Red Sea since January 12. That has had a dramatic impact on the flow of LNG cargoes. Not a single Qatari cargo has gone through to Europe through the Red Sea during that period of time. Qatar announced publicly was ceasing all transiting of the Red Sea as of February 1. As a result, all cargoes from Qatar to Europe are down by 50%. And those that have gone through have had to go around the Cape of Good Hope, so that Europe has been supplied by Qatar for only about 2,500 million tons for the first 4.75 months through today, from February 1. That's 12% of all Qatar's LNG. That's almost exactly half what it was last year, both in percentage and in total terms, over 5 million tons this time last year, 21% of Qatar's LNG. So Qatar is redirecting to Asia. U.S. is redirecting to Europe. We'd like to send more to Asia, but with the Panama Canal slowed down the way it is, and if we end up not selling to China, we really have a re-Balkanization of the LNG industry, and it's going to make it more difficult. It hasn't affected price yet very much because the world is flush, but it's going to result in a re-Balkanization with regional blocks that make it difficult to swing to respond to geopolitical crises like Gabe has talked about, and also to respond to ARB differences in prices. And it will result in, most likely, as some of our friends over at Oxford have called it, interregional price premiums. And so I'll leave it there for now, but I think we have to watch this very carefully because it's taking us back to the future about 25 years.
This has been a fascinating conversation. What comes through loud and clear to me anyway is there's so much beneath the headlines about LNG export bans or pauses. Gabe, do you have a final comment you'd like to make?
I'll give you a very simple one. Let commodity markets work.
Bingo. Exactly right. And those who think that swapping everywhere is going to solve it, no. Swaps only work within large traders' own little black books. Other than that, it's too complex. The force majeure clauses, the delivery clauses, the failure to take, the failure to deliver clauses, they're all different. Unless it's within your own little black book, swaps are just not going to solve this interregional problem.
This has been a fascinating conversation, and I have the impression that the two of you could go on for quite a while talking about the various scenarios. Listeners, I will remind them that you have written a recent article that's now out in Foreign Policy magazine on this very topic and the various scenarios. So I encourage people to go read what the two of you say, because you're truly experts. And I appreciate your being here today.
Thank you for the opportunity.
And thank you to our audience.
Baker Briefing is brought to you by the Baker Institute for Public Policy, which provides meaningful, nonpartisan policy analysis on the most critical challenges facing Texas, the United States, and the world. Baker Briefing is produced by Victoria Jupp, Shannon Moriarty, and Karina Zimmel, with support from Laura Gould. AV production is led by Kevin Young. Be sure to visit us at bakerinstitute.org to learn more, and thank you for listening.